cap tables and shareholding. Cap tables and shareholdings are the most important steps in getting a company organized and are critically important for another reason. It tells a story about your company to make your company's story a success. It is important to know about these steps to make your company a success company and to help you climb the steps of cap tables and shareholding. I would like to invite Mr. Yagnesh Sanghrajka. Mr. Yagnesh has had a long and successful career in the corporate world, having led finance and M&A strategy and investor relations for various organizations, large and medium sized, listed and unlisted. Yagnesh, sir, currently is the founder and CFO of 100x VC, India's first SEBI-registered venture capital fund, which uses iSafe notes to fund startups. iSafe is a founder-friendly instrument, a simple five-page document which is easy to understand and doesn't need founders to incur high legal and execution costs. iSafe is ideal for early-stage funding and can help founders raise funds in a fast and effective manner. 100x VC is promoted by Mehta Ventures, a family office owned by Ace Angel investor Sanjay Mehta. 100x VC has funded 50 companies till date. And over to you, sir.
Thanks, thanks Arthyan for having me. Thanks Manasvi. Excited to share our thoughts, and I'll just present my screen right now. Sure. Okay. Well, as the suggestion, as the title goes, funding demystified. 100x also stands for funding simplified, and I'll explain to you in a bit. So, welcome you all for this Sunday session. Thanks for making time. Uh, Before I begin, just wanted to share a few thoughts. When you talk about cap tables, structuring, it's all about numbers, right? One has to be comfortable with numbers. Uh, while a lot of founders understand their product well, understand the pain point, but it's of less use if you don't really understand the numbers that are typically important from a investor perspective. So let's understand more numbers, and then you'll understand the cap table and the structuring bit as well. So before I jump into the main session on the topic, I'll just kind of give you our perspective on some of the reasons why startups don't get funding, are not able to invite investors, are not able to excite investors, and here are a few reasons why. Uh, so companies which can't grow fast, right? I mean, they are not able to absorb capital. That is, there is a definition of who can absorb capital, who can't. There has to be a constant need for capital in businesses for you guys to attract VCs and institutional investors. uh, Typically asset heavy businesses are unable to attract funding. If you are going to put all your money into assets and not really sales growth, all of that technology innovation, then it becomes an uninteresting deal for VCs. So VCs like to invest in companies which are asset light business models. So focusing on that, also as I said, founders try to explain their product more than first focusing on what problem they're solving. Complementary skills are important, and here's to do with numbers again. There is no clarity on financial metrics sometimes. Basic unit economics is not clear, or are unable to understand or explain to the investors, and how the unit economics will change with volumes that come into the platform. That's very important. And our main topic is also one of the reasons why startups don't get subsequent funding, and the reason is capital structure. Very important. Early on, you dilute too much in favor of your friends, family, you become unviable for funding. So very much important. Too early in the life cycle, there's very heavy dilution, and that just scares the investors and the marquee and the institutional investors away. So remember that, and let's talk more about that in the coming slides. Always take advice from important people who have done this, who have been this journey, and not just consultants who are looking at it from a distance. uh, some tips, while you guys meet investors all the time, you're going to be pitching to them. Please understand few things which are very important. Remember that your goal is not to close the discussion or come to a valuation or come to a deal structuring discussion right in the first meeting. In the first meeting, it's going to take time for the investor to understand what you are doing. uh, it's always very important to leave one or two very important points that the investor will remember about your startup. So the idea is to not really close the meeting with a question saying will you invest or not. It is actually to get the next meeting. If you are getting the next meeting, it's a signal of the investor's interest in the startup. So, investors don't really choose to commit right on the first day that they hear your pitch. It takes time for them to warm up to the opportunity. So always try for more and more meetings. Investors are looking for compelling founders who have a believable dream, and as much evidence documenting the reality of that dream. So remember that. Uh, so few steps right in the journey. First of all, you yourself as founders will need to have enough conviction in your business idea. If you don't have that 100% conviction, then there is no way you can transmit that conviction into the investors' minds. And this goes a long way in your valuation expectation and all of those discussions later. Do enough research, raise some initial funds so that you reach an MVP stage or reach some viable product, some prototype for that matter, and that will help a lot in your future rounds of discussion with investors. Get the right team in place. Get them to cover all the key aspects of your business. Somebody should be able to see products, somebody should be able to see sales, and one of you or some of you will have to designate someone who starts talking to investors, because this is going to be a full-time job till you get your round closed. Get your differentiator right. Of course, competition, all of that. I'm sure you've heard some of these words. Very important in the journey. um, Obviously, some pitch deck tips I will share with you in a while. Study the funding in the space. A lot of founders sometimes do a very high level study, leave one or two things on the table, and then just move forward. Try to dive deep in the competition area. You should know your competition well, right? You've heard that phrase. Apply it in your startup as well. See which investors like your sector, because those are the ones that you will be going to. Just like you go after your customers, you have to go after your investors. That's how you will be able to close your round. So, essentially, just wanted to let you know how we see or funding. When should what funding happen? So typically, as we discussed, right, post a prototype, which is basically nothing for but customer discovery, an MVP stage, which is for customer validation. This is exactly where the seed stage funding should ideally happen. Right. Post that, of course, once you are funded, you have enough money for the runway. You can keep adding customers, users, whatever that is, to find that elusive so-called perfect market fit, product market fit. That's very important. And only after that you will be able to scale. So if you receive some initial traction, some guys talking good about your product, don't really think that you can scale, or don't really think you've reached that product market fit. It's very important to go step by step. I won't go too much into detail about the each stage because that's not the topic of our discussion. But let's move forward on the pitch deck, and what is a perfect pitch? There's nothing like a perfect pitch. Whatever gets you your first investment is your perfect pitch. Some of the things that I said right in the pitch deck, what all you should typically have, and don't miss out on any of them. The pain point, the solution that you're offering. These are the initial slides that attract investors' attention. Uh, Immediately, the founder's profile should come. Why should you be the best team to do it? Your role, your experiences, your past work. What roles are you assuming in the venture? That is sometimes missed out by founders, and hence a lot of interest gets lost just in the initial 5 minutes of the pitch. So important to keep that sequence. Product, services, whatever you're offering, delivery model, the market opportunity, of course. Peer comparison, this is very important. Try to create tables of feature comparison that will help you to differentiate your product from somebody else's product. Of course, initial testing milestones, etc. Future roadmap, this is the important slide. Sales, market, and product. Where are you going? How are you really going? How is the go to market? which channels will you apply, if it's a B2B sales, what kind of sales strategy will you have, if it's a B2C, what channel are you using, performance marketing, all of that. So far what investment is gone in, what traction if at all you have, and if you are a pre-revenue, then at least what kind of initial user traction you have. Some key metrics which are very important before I talk about valuations, etc. uh, and of course you should end it with your timelines of how much money you need and for what period you need. That is very important. Broad bucketing of the end user funds is very, very important. Of course, don't forget to leave your contact details, etc., in the last slide, because if you send the deck to someone, they should know where to contact you, how to contact you. Some of the key metrics that are very, very important. I'll just run them through in the next 2 3 minutes. Uh, by this time, Manasvi, am I audible? I just want to check the connection. Is it okay? Hello? I hope I'm audible. Hello? Uh, I'm just stopping here to see if I'm audible. Manasvi, are you there? Okay, fine. Thank you so much. I'll progress with my slides now. Let me put back the presentation on. So yeah, few metrics. Very important: top line revenue, users, uh, cost. Cost are bifurcated: directly and indirect costs, which gives you your margins. Your gross margin is the first level that you should look at. Very relevant for hardware product companies, because SaaS companies typically don't have too many direct costs. But yes, a lot of product companies have some direct cost. If you are an e-commerce marketplace channel, your cost of running the channel, your cost of delivery, logistics, all of that become important. EBITDA is something that we arrive at when you reduce your indirect cost from your gross margin. And of course, some of these important things are relevant: customer acquisition cost, which is what you spend on marketing, go to market, all those channels that you talk about, the Facebooks of the world, the Google, all the ads that you spend are all included in the customer acquisition cost. Whatever converts your customer into a paid customer or a user. Then there's something called lifetime value, which is the LTV. There's a ratio of CAC to LTV that you have to maintain. Uh, Daily average users, monthly average users. These are very important from a platform perspective. Retention is something that is very, very important. Not many people understand this, but key investors always look for retention, repeat, all those kind of metrics. Understand your traction well, understand the funnel, how many users, and then how many converting into active users, and then how many eventually convert into your paid users. So those are the conversion metrics. Dilution, of course, we'll come to that. We'll talk more about the valuation. So this is how typically, I just thought I'll flash the sample P&L kind of thing that you should be preparing for your investors, because investors love numbers, figures, right? So figure out your top line, figure out your gross margins. Some of the key items that you can see here are salaries. Team salaries can be divided into exactly few buckets, so people understand which bucket are you spending what amount. In case of commissions going out, put that. Website maintenance and all of those server cost, etc. Then there are administrative costs of running the company, compliance, the administrative. And even while you are burning, your projections show burn. All of that has to come from these row items, right? So just after discussing the numbers, just few important things that you should understand, and then we'll jump into the valuation bit. Uh, so let's say most startups like yours wouldn't have a history, right? There are no past revenues, no track record. So conventional methods of cash flow discounting, etc., don't work in these kind of situations, right? What really works is these things. Uh, all these build up valuations in the investor's mind. Which stage you are at, how many users do you have, how many satisfied good users you have, what is the retention matrix, what is the quality of the founders, what is the IP, is there really a technology behind the delivery, is it something unique, some disruptive element, and then of course cash required to pivot or cash required to reach that next milestone, because there is the function of cash required which will work out the stake that the investor will get when he invests that cash into the company. So there is a direct correlation of, that's why we ask you, end use of cash funding requirements. Why do we ask you that? Is because if you arrive at that cash, you will know how much to dilute in favor of the investor, and that typically backworks and gives you a valuation. And I'll show it to you how, right? Of course, there are enough instruments in the market to raise money, but the most useful and the most popular instrument is the CCPS. The preference shares is the mode which most investors use, and ISAFE is another type of CCPS. We'll talk more about it in just a bit. Yeah, so you know when what, so I already said, right, founders need to raise initial capital to just reach a particular stage where it is presentable to an investor, and an investor can see the future with whatever present product you have. That requires a lot of planning, a lot of foresight. It's much harder than you think. So always think from investors perspective, right? Whom should you approach for money? Initially, of course, your friends, family, co-founders need to also put in their money and skin in the game. The more you achieve with these comparatively easier accessible funds, the better it is, because the investor is going to be a hard process, a very long process. There will be a lot of attention time required. Your near circle, your close circle is probably easier for you guys to convince. So that approach is also good enough. uh, Always remember, of course, early stage startups don't get too much debt, and banks of course don't fund startups. So equity is the only mode, and hence we recommend the use of iSafe notes, and I'll talk more about it in our session now. Unit economics is very important. Understand your average selling price, understand your margins well. Very relevant for products and the consumer discretionary sectors. And please understand one thing: valuation of startups initially is always an art. There is no science to it, there is no math to it. As you keep growing, as you keep raising more funds, your company starts hitting revenues, you capture some market share, then it starts becoming a science. So that's what it is all about. And then few things very important. Understand from an angel VC mindset, right? They are also taking money from somewhere. There are investors who invest money into invest funds, and the funds are going to invest in you. So they have their own limited partners or investors to be answerable for, and they are expectation of a return. So understand one thing is they also have to return that money with that appreciation, with that IRR, which is the expected rate of return. And you once you start thinking from that mindset, your own goals, your own objectives will change drastically, and you will be able to then understand how a VC thinks, and that is very important. So just last few things on this. VCs always look for, angels always look for solid promoters, founders with complementary skill sets. They should be able to hustle. It's not that if you don't understand numbers, business, you can't do a startup. You can. You will have to learn it. It's the tenacity to learn and execute is what is important. Validation of data points, statistics, robust business model, very important, and of course the MVP stage. So with that, let me just move on to the next section, and I'll kind of take the next section here. uh, Investors always understand things in terms of money, right? So what happens is when you talk something, investor is hearing something. They think that with the team is this team going to make me money? They think that with the team is this team going to projections? They think that with the team is this team going to make me money? and then the terms of investment and exit, which we will talk about now. How much money can I make? That is very important, the answer, right? So that's what it is. So let's jump into understanding cap tables now. And we'll uh, hearing some beeps. I guess I think it's okay, right? Are we still on? Yeah. All right.
Yes,
Thanks.
sir. Yes, yes.
Thanks. Okay. So
So
now just
actually, your screen is not visible. The presentation.
oh, I did start presenting. Let me start again.
Sure, sir.
Yep. Is it okay
Also,
now?
your voice is breaking a bit in the middle.
Yeah. Is it okay now?
Yes,
Master?
sir. Yes,
Okay.
yes.
All right. So, with that, let me just jump into the topic today, understanding cap tables. What is a cap table? It's an ownership pie. It's the whole 100% of the company that we're talking about. It's called, in other words, it's called shareholding pattern. Initial stages, founders always own 100%, right? When you form a company. And here, let me just stop and tell you, if you are really serious about your venture, if you are going to make this into a important and big story, please form a private limited as soon as you can, because investors will not invest in an LLP or a partnership or a proprietorship. This is a common mistake we have seen in some founders. They start the venture, some CA advises them, LLP is fine, proprietorship is fine for now, and that may be okay. But if you are talking serious money, investors, talking to investors, please immediately form a private limited. That will help in the timelines to close. So once you have that, of course, initially there is a small equity that goes in. Founders typically own 100%. Each investor is investing funds in the company, right? At every stage when you invest, the founder's stake keeps reducing. Your 100% pie will go down to 90 and 80 and so on and so forth. There are various stages of fundraising, as you would have read. Pre-seed, seed is the stage at which early stage VCs like us come in. Pre-series A, slightly bigger VCs come in. Series A and so on, it's the big boys game, and the larger ticket sizes then get discussed. Key hires, very important. You need to keep in mind a particular kitty for your key team. Uh, this is, I'm talking apart from the co-founder. So if you have your key team, your key people who are delivering day to day, you need to have some small percentage kept aside for them, which is called ESOPs. So with that, just this diagram shows what's the journey for a startup to the IPO, right? We also saw Zomato's huge success, and 10 years back, this is how they started, right? Dipender Goyal would have started with this 100% company, then a co-founder joined in. Some close family friends would have taken some investment. After that, there is a seed round from an VC, which kind of also creates an ESOP pool at that particular point of time. At each stage, as you can see, the valuations keep increasing. Series A, the pie gets even bigger. More beneficiaries to the pie, more investors join in, and eventually you have the IPO, which invites retail participation. So till there is an IPO stage, there are only select investors participating. But remember, in an IPO, each and everybody, those who have 10,000 rupees, also can invest in our startup. So that's what has Zomato achieved, and that's a huge milestone in our startup funding space. With that, let's move on to the valuation piece. Typically there's always a pre-money, post-money that you think, right? So what is this pre-money, post-money? Pre-money is something like a figure which is valued before the investor puts in his check. So let's assume, in this example, investor is putting in 2.5 crores. He wants 20%. So when somebody tells you that I want 20% of the company and I'm willing to put 2.5 crores, it essentially means that your pre-money is 10 crores and your check is going to be 2.5, which makes your post-money 20%. Now, this is very important. The stake of 20% is calculated on 2.5 divided by 12.5 and not 10 crores. So, what the valuation is, always percentage stake is worked out based on a post money. So, just remember that bit. And that's how the stakes are worked out at each stage. Typically, this is important, to understand how investors perceive risk at each stage of investment, right? So, at the seed round, product risk is there because the build out is just begun, product is halfway through, few features are yet to be built, so it's a pre-seed round. Let's say you have a product ready, some prototype ready, then you understand which team members are going to handle what. The team risk happens at the seed round. There is a business risk that comes in at the angel round. Then, of course, there is execution and then scaling and growth and so on and so forth in the future rounds. So that's important to understand. And as I said earlier, how to compute valuation. So when you have a startup, it's difficult to value the company. The profitable companies are valued based on a profit to earnings multiple. Loss making companies are valued on a sales multiple, which means multiplication of sales. If you don't have sales, then you look at users, then you look at number of users, then you look at your average users, you look at your registered users. uh, all of that will help you arrive at some sense of valuation. And remember, while we are talking this, startup is not just about valuation. It's also about building a product that is 10 times better and grows 10 times faster than anything else. And valuations will catch up in the end. So don't worry too much about that. It's more important to find an investor, get that check commitment, and that's what is most important. As I said earlier, there are few methods of raising funds. Lastly, we have seen debt and venture debt also coming in for well-funded startups, but that's not true for the early stage. So early stage investors typically invest through a CCPS, which is compulsory convertible preference shares. So coming to now the dilution piece, right, that I've been talking about. Typically, let's say this is an example and not really true, so don't hold me to the numbers. But typically, in every round, there is a stake that goes out to the investor. This is just a diagram of that. 85%, and then next round founder's stake reduces to 55%, and then going down to 40%. So that's how typically the thing works. Here is the mathematical table to kind of explain to you how this math works, right? The whole pre-money post-money thing works based on the math of 1 crore divided by 6.6, which is the post money. In the next round, the company would have gone ahead, would have got more customers, and hence, assuming there is a enhancement in valuation, the next round would happen at a significant premium to the previous round. So the next round will typically happen at a higher valuation, and then Series B would have again a jump of that to the previous round valuation. So here you can see how the startup in this example has raised funds, right? 6.6 crores. Next round is happening at 37 pre, 57 post, and then next round happens at a 3x, which is 171 crores, which is almost three times of 57 crores. So this is how typically the fundraise works. uh, you can see the cap table here, right? Starting with 100%, with the first check of 1 crore, there is 15% going out to the investor. Founders have the remaining 85. After that, the next investor is coming in. He is putting in 20 crores. He's taking 35%. The old investor and the founder dilute here, right, to give that 35%. So the angel investor who had 15% has now got 9.75 because there is new infusion. Likewise, at the end of Series B, if you really see here the cap table, it is at 40%, 7% is owned by the angel, the Series A investor 25, and then the new round of 27%. So if you can see the valuations, right, the investor who put in 1 crore in the angel round at the end of Series B is actually at 17x. It is 17 crores worth of valuation, which is worked out at 7% of 236 crores. So if you work out 7% of 236 crores, it comes to 17. So you can see the kind of appreciation that angel round guy made. Even Series A guy, right? The guy who put in 20 crores, or multiple investors putting in 20 crores, are actually at a 3x. They are coming to 60 crores in the next round because the valuations have jumped to 3x. So this is the valuation in terms of rupees. This is the percentage stake. I hope that was clear, but we'll happy to take questions at the end of the session. Few things to be keep in mind when we are structuring the cap table. uh, Initially try not to issue too much equity to mentors, advisors, uh, as they are not full time and they will never be. So giving a high percentage of equity to mentors, advisors will just spoil your cap table, will ruin your chances of a further fundraise. So always remember that your first investor is very important. So whichever first institutional large investor you're talking to is very important, because they should be able to bring in a lot of value, connects, fundraising prowess, and they are the ones who are taking the maximum risk. Secondly, angel investors are suited for early stage. They invest smaller checks, like the range could be anything like 2 to 5 to 10 lakhs to 25 lakhs. Institutional investors, VCs, micro VCs issue larger checks, and some lead the round, right? The entire round can be led by one major investor, and others can just tag along and co-invest. So check sizes vary from 25 lakhs to 5 crores to 10 crores. They also do follow-on rounds, by the way. Typical angel investors may not end up doing follow-on rounds, but VCs are always, if they are very bullish about the company and the prospects later on, they also are ready with doubling down their investment. Also, what to keep in mind is that angel investors and HNIs take less time to decide. VCs will take more time to build their conviction, to build their thesis, to be able to be convinced about investing and issuing a term sheet. VCs typically lead or participate in a pricing round. So, iSafe notes and others are very, very useful for angel investors and small investors. But larger VCs would always come in with a pricing round, which means you have to do an SHA and a big document that will take some time. Uh, and that's how the terms of investment happen. At 100x, let me just stop here and tell you what our thesis is. We look at the founding team, we look at the market size opportunity, we look at the business model strength, we look at the moat, the unfair advantage over the competition that you might have, and a conviction of a minimum 20x returns. So this is multiples of investment that typically early stage investors have. Just talking a little bit about iSafe, and I'll tell you the advantages of that for founders. We launched the iSafe in 2019. So far, we've funded 50 companies through iSafe in the last 21 months. And all our 50 companies, most of them went on to raise the next round, the seed round, and they have actually collectively have raised more than 115, 120 crores right now. So what is iSafe? How does it work? It's more suited for early stage startups. It's called India Agreement for Future Equity. It's a simple agreement for future equity. So it's more suitable for startups where there are no key metrics available. It's a simple 5-page document. No need of expensive legal cost, etc., execution cost. It just gets concluded in 2 to 3 weeks, uh, so that founders can then focus on the business and not too much of compliance and documentation and all of that. So, and of course, it's completely legit, works as a CCPS, as I mentioned. So I just want to give you guys a little example of how our portfolio companies have raised funds, right? You would be curious to know, if you are a part of 100x, what would you entail, right? How much the dilution, now that you understand dilution, cap table, how does it work? So in case of a company, you can take, right? SHA round happened straight away. A VC got interested. There were a couple of angels, but a large VC gave in a term sheet, and the terms were like 16 crores pre and 20 crore post. So 4 crores got raised. The founders ended up with 73%, and the investors, including including 100x, had 27%. Uh, Again, second example is an iSafe example where post 100x investors came on iSafe. So 2 crores was raised at a 13 crores cap, which means that it was a cap at which investors invested. Founders ended up with 78%, and total dilution of investors in favor of investors was 22%. The third example was a smaller raise. Sometimes founders tell us, sir, nahi, we just want 1 crore right now and we are good to go, which is fine. We allow founders to raise as much as they feel they should raise at this point. So, that happened at a 15 crore cap, and hence you can see the cap table, founders 86% and the dilution of investors was 14%. So this is how the whole iSafe round works. uh, it's of course a very friendly, founder friendly document. Legally it is CCPS, so it comes on the balance sheet of the founder as CCPS. It is neither debt nor equity. There is no interest accruing on on this instrument, and it's a convertible note basically, and promise for a future equity to the investor. I'll kind of stop here now, and this of course open source. You can go and download the iSafe from our website. Again, thank you so much for the Arthian team. There is an ID here. You guys can always mail your decks to pitch at the rate 100x.vc. My